Welcome to our brief video related to performance measures. In this video, we're going to talk about specific measures that we can use to measure the performance of business units. If you recall, Chapter 14 is talking about dividing an organization into business units. The organization is very interested in finding out if these segments are performing up to expectation. Now, as we go through this material, keep in mind that the measures of performance work just as well as if we are measuring any capital projects or special projects that a company may have. To consider these performance measures, let's look at three divisions. We have the Northern Division, Central Division, and Southern Division. Based upon operating income, it appears like the Central Division is doing the best. The operating income for Central is $84,000, while the Northern Division is $70,000, and the Southern Division is $75,000. What we want to consider is how each of these companies perform in comparison to the amount of capital that we have invested in each of these divisions. As you see, the invested assets for each of the division varies. Northern Division, we invested $350,000, Central $700,000, and the Southern Division $500,000. The first measure of performance that we will consider is the return on investment. In the return on investment, we are considering the net income in comparison to the contributed capital. So let's now calculate the return on investment for each division. Calculating the return on investment, the numerator is our net income for the division, and the denominator is the contributed capital. The Northern Division, $70,000 divided by 350, gives us a return on investment of 20%. The Central Division is 12%, and the Southern Division is 15%. This is interesting from the perspective that when we looked originally at the net income, the Central Division appeared to be doing the best. However, when we consider this from the perspective of contributed capital, we see that the Central Division has a much lower return on investment as compared to both of these divisions. The reason the Northern Division has a much higher return on investment relates to the fact that the contributed capital is $350,000, which is half of the amount that was contributed to the Central Division. Once we consider the performance of each division from the perspective of the contributed capital, we get a much better sense of which of these divisions is doing better. Let's now take a look at the Dupont Formula. The end result of the Dupont Formula is the return on investment. However, when you see the calculation, what we have is two separate calculations. The first being profit margin, which is operating income divided by sales. The next component is the investment turnover. The investment turnover is sales divided by invested assets. When we take a look at each division using the Dupont Formula, we have a much better idea of how each of these divisions are performing. Let's now take a look at the Dupont Formula for each of these divisions. The profit margin for the Northern Division is 12.5%, which is the same for the Central Division. Southern Division lags at 10%. When we look at the investment turnover, the highest is the Northern Division. Clearly, the Northern Division is impacted by the fact that the invested capital is only $350,000. The lowest investment turnover is the Central Division, clearly because this organization has an invested capital of $700,000, and the Central Division is in the center. So by taking a look at the Dupont Formula, we do end up with the return on investment, but we're able to take a look at each of these individual components of the organization and have a better understanding of the overall performance. Let's now take a look at the concept of residue income. Residue income is the excess of operating income over a minimum acceptable operating income. The minimal acceptable operating income is computed by multiplying the company's minimal rate of return by the invested assets. Each organization will have to determine its own minimally accepted operating income. Once we've determined that, we can see if these organizations or these segments within the organization are meeting the minimum standards, the minimum requirements established by the organization. So in the case of our organization, we have established a 10% minimally acceptable return on division assets. We take this 10% and multiply it by the invested capital. So with the Northern Division, we take $350,000 times 10%. Central Division is $700,000 times 10%. And the Southern Division is $500,000 times 10%. We then subtract this from the operating income. What we see is that the Northern Division is performing the best. However, each of the divisions are performing above the minimally acceptable returns on the divisional assets. So in this video, we have identified several tools that we can use to assess the performance of individual divisions. Each of these tools require an understanding of the amount of money that we have contributed to start these divisions. We looked at the return on investment, the Dupont Formula, and our residue income. I thank you very much for your time and have a good day.